Talk Money.
Hello and welcome to a brand new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Factor-based investing. Now, this is something that's beginning to see a fair amount of interest and traction in India. Many asset managers are launching funds based on factor strategies. But how do such funds actually work? How do they operate? What is their methodology of picking stocks? And most importantly, should you be investing in these funds? Well, you've guessed it. Today on Let's Talk Money, we are discussing exactly this. It's a classroom on factor investing and factor-based models as well as funds. How do they operate? How do they work? And the things that you should keep in mind before deciding to opt for some of these strategies. To help us do this, we have with us Pradeep Kesavan of SBI Mutual Fund, as well as Harshvardhan Roongta from Roongta Securities. Gentlemen, great to have you, and welcome back to the show. You're no strangers to Let's Talk Money. Slightly complex subject at hand today, Pradeep. Would you agree?
Not really complex. Once you get into the ins and outs of it, it's much simpler, right? Like, let's put a simple structure so that people can understand easily. So at the core of corporate finance, right, like people look at value, right? How does a company create value? A company creates value when it generates returns in excess of its cost of capital, right? That's the core of what we call as corporate finance. Now, while doing that, if a company also grows fast, then it enhances shareholder value, right? This is a very simple structure of how investors normally look at companies. Now, in factor investing, what we do is we look at each of these typical characteristics separately and then analyze to see if that characteristic can provide us an edge. That is what we call as factor. Now, for traditional investors who are anchored into understanding industries, for example, industry structure is something that everybody understands. There, what are we saying? We are saying all companies which are producing cement or cement companies, all banks or banking companies, so on and so forth. In factor investing, we are just twisting that a little bit. And then what are we saying here? If, for example, I'm interested in looking at companies with low leverage, I'm going to cluster all low leverage companies into one bucket. I don't care whether it is a technology company, consumption company, or a healthcare company. And I'm going to look at it together and analyze that. That is all we are doing. That is all what is called factor.
It's a different way of looking at companies, different set of filters or a different lens that you put. Instead of maybe size or a certain sector, like you said, it could be different attributes that we are considering. But, Harsh, I think people will ask the question that when we give our money to fund managers, active funds, we think that they're anyway looking at quality companies, stocks that have low volatility or stocks that can have great return potential. They're investing in high growth companies. So investors will ask, and why bother with this new style of investment?
So, Surabhi, Pradeep has very nicely articulated it to say that, what is that factor investing, right? So, assume you're an investor. Now, you say that I have a low volatility as a requirement for my investments. Okay, so what is you very clearly saying that, look, I want to invest into equities, but I don't want to invest into high volatility-based companies. So what you can do now is that you pick a factor fund, okay, which has that factor, the filter that we're talking about is low volatility. So you are satisfied to that extent that my investment is going into those companies which are low on volatility. At the same time, on the other hand, you would say that I want to invest into into an aggressive portfolio. And because the markets are in a structural bull run, why not I pick the momentum strategy? So when you go to a diversified equity fund, though the underlying concepts of investments would be the same, I mean, they would essentially try to make the maximum of everything put together. In this case, you are satisfied to that extent saying that, look, I am playing the momentum strategy. Okay, markets are in a bull run. I want to play the momentum strategy.
So basically, it's a way of cutting across sectoral bias or market cap as a big, filter, looking at playing different attributes, like you explained. It could be momentum, it could be low volatility, it could be high quality, so on and so forth. And we will discuss a lot of these individual factors in just a bit. But before we get down to that, another very basic question, and investors will ask this, because if you go to the stock exchange websites, and I went to the NSE website just to see the kind of indices which are already there, and let's pull up that list if we can actually. So NSE has lots of factor-based indices. I'll just take some names to give an example. There's the NSE 100 Quality 30, there's a Nifty 50 Value 20, there's the Nifty Alpha 50. The BSE, by the way, these are the Nifty indices that I'm naming. There's a Nifty 200 Momentum 30. What do all of these mean? We'll talk about that in just a bit. But just want to say that it's not just the NSE, the BSE also has its own set of indices. To name a few, there's the BSE Momentum Index, there's a BSE Low Volatility Index, BSE Quality Index. So this is stock exchanges using these filters and then selecting a certain group of companies. Which, Pradeep, brings me to the other question. So when we say factor-based investing, are we essentially talking about passive funds, or could it be active as well?
Yeah, it's a good question actually. So like I said before, right, factor-based investing is a way of investing using factors, right? Just like in any other investing, it can be passive, it can be completely active, or it can be somewhere in between also. In your example, if you take one of those nifty indices that you mentioned and then simply follow that, then it becomes passive.
Okay.
On the other hand, an active fund manager can also actively think about factor tilts. Like, for example, if the market, like Harsh is saying, like market is in high momentum, I want to add momentum to my portfolio, he or she can choose to add momentum. Similarly, in a downtrending market, if they want to reduce drawdowns, they can say, I'm going to reduce my drawdown by looking actively at low volatility stocks. So then in that scenario, it becomes a completely active way of looking at factors.
Okay.
But mostly when we look at quant funds, so to speak, they kind of fall somewhere in between completely passive and completely active.
Okay.
Some sort of a smart beta kind of a strategy where you have a construct of what you want to do. There is an intervention from a fund manager, but to a minimal extent and not fully to the extent that an active fund manager will be doing it.
See, now we know how fast the mutual fund industry is evolving, right? There is factor-based funds, there are smart beta funds, there are quant funds, and then there's a traditional active and passive. So what you're saying is that there could be simple passive funds just based mirroring some of these indices that I named, and there could be strategies which are kind of in between, a mix and match of both. Just to understand from an industry perspective, where are we heading? And what do we see in the West? Is it more about just following the index? Or, are we likely to see a lot of these blended strategies?
Absolutely. So following the index will give you exactly the index return, right? And there is a large set of investors. In fact, everybody wants a little more than what the index can offer. And by mixing and matching factors, so if somebody can prove to you that I can generate what we call as an alpha, something in excess of what the return that the index will provide, that is something that might be attractive, right? So that is where some of these smart beta strategies and mixing of factors and multi-factor models come into play. And the market will move towards that. Like in terms of many of the quant funds that are already in existence and more, in my opinion, will come in, we'll all look at multi-factor models.
Multi-factor models, which is also called smart beta investing. So don't get confused if you increasingly hear these terms in investment circles. It's the same thing. When you combine multiple factors together, you have multi-factor investing. It's also called smart beta investing. So that brings us to the basic question. What are these different types of factors? So let's try and address them. And there's several of them. Harshvardhan, help us out here. So like you said, there could be, low volatility you described. What are the other, some of the major factors that we see becoming popular here in India?
So you'll have an equal weight. I mean, that is also one of the very smart, product. Like for example, you have a Nifty 50. So in Nifty 50, there's a basket of 50 companies, and each company has different weightage. So HDFC Bank would possibly have about 13% kind of a weightage, and the 50th company would possibly have 0.5% weightage. Okay, when you have an equal weight, Nifty 50 equal weight, all the 50 companies will have a 2% equal allocation. So I'll give an example. So HDFC Bank, as I said, in a Nifty 50 has about 13% weightage. In a Nifty 50 equal weight, it will have 2%.
Correct, because all the stocks have been given the same
Equal
weight.
weightage.
Yeah, they all contribute similarly to calculating the index value.
Absolutely.
Yeah.
A company which has, say probably Hero MotoCorp will have a 0.5% kind of an exposure.
Sure.
In an equal weight, it will have 2%. So that's one strategy.
That's a strategy, correct?
Yeah, that's one of the equal weight is one factor.
Is one
factor
okay.
that we're talking about.
Okay.
There is momentum, as we spoke about. That if in case you want to ride the market, the bull run in the market, you possibly take a momentum strategy.
Which means that these stocks, momentum stocks, will be the ones that will move faster than the market on the way up.
Yeah. So basically, what happens is you have a Nifty, say 500, momentum 50 kind of a thing. So they only pick 50 companies out of that basket of, say, 500 or 300 or whatever Nifty base that you're making. So you'll have companies which have shown 6 months or 12 months return, adjusted to volatility, they've been doing well. So possibly you try and get some momentum over there. Okay. Then you have value, saying that, okay, I want to invest only into companies which are reasonably valued. Okay, we don't want something which is overvalued to enter into right now.
Value becomes another filter.
Another filter.
Yeah.
You would have low volatility. I've already mentioned about that. You have alpha that you want to possibly invest into companies which are outperforming, or the chances of performing better than the market are there. So you want to generate that kind of a thing.
Everybody would want that, right?
Yeah,
It's
but
all
then-
about looking for alpha, outperforming the index.
So you mentioned about the NSE website. So if
Yeah.
you go into that NSE same website, you'll have a methodology. They have one downloadable PDF. It's a very elaborate document where they have actually very detailed. There is a detailed note on what are the parameters which fit into those
Into
requirements.
alpha, into low volatility,
Yeah.
etc.
So quality is one.
Sure.
So these are various parameters or various factors, if I may use.
Okay, Harshvardhan, I think we've got a fair enough idea now. We've spoken about a couple of factors: momentum, there is low volatility, there is value, there is growth, there is alpha. So I think that's enough to kind of work with. But what's important to keep in mind is the fact that not all of these factors move up together, and then all of them don't move down together as well at any given point in time in the market. So let's look at some data, which actually SBI Mutual Fund's research team has helped us map. We wanted to understand which factors work how in the market during different periods and different cycles. And as this chart here tells us, you can see it's a very diverse shade of all kinds of colors. So in 2029, this last 5 years, 2019 and 2020, it was actually the quality factor that was outperforming. The market wanted to own quality stocks, and things like value were not performing. It exactly reversed and flipped over the next 2 years, 2021 and 22, because suddenly value stocks were in vogue, and they were doing very well in the market. Momentum as a factor was also coming up in favor in 2022. In 23, that's the last year, growth became the dominant style. So what we know is that all the factors can move in different ways at different points in time, which, Pradeep, brings me to the other question, that this could get a little daunting and confusing for investors. How do I know which is the right factor for me and which is the right factor to pick, say, if I want a 5-year portfolio view?
No, absolutely. It's an interesting question. Like you rightly said, various factors can perform well at various points in time in different market conditions. That's the reason why one should look at a multi-factor kind of an approach, right? Like, because what happens is timing the market or timing the factor is always going to be risky. So it's better to play a multiplicity of factors so that at least something or the other is going for you. Then again, the question arises as to how do we weigh a particular factor vis-a-vis the rest of the factors. Then therein comes the idea of going back in time and testing out, right? So to start with, if you choose 3 or 4 factors, a saner way of doing that will be just take a decision that I cannot be deciding on how much weight going in should I be giving to each factor. Just treat each of that equally, go back in time, test for its performance over a long period of time in a backtesting environment, see what works, and then start implementing those.
Heavy stuff. Short point, if you're not a finance professional, don't do it on your own. Get some help. Well, we've done a lot of theory. We've understood the basic concept of factor-based investing. Now, how do you apply it to your portfolios with the help of perhaps an advisor? We discuss this after a break.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week, we are discussing factor-based investing, what is also known as smart beta investing. So all of our viewers are extremely smart, and I'm sure they want that extra edge into their mutual fund portfolio. So that's the question, gentlemen. Now that we've understood the concept, the point is that in your mutual fund portfolio, which anyway has lots of diversified mutual funds, and I think a lot of people have understood that you need to have a basic index fund, like a Nifty fund maybe. How do you add this whole factor-based approach, Pradeep? And to what extent, 10%, 5%, 20%, right, how should you design the portfolio then using these?
Yeah, so to blend into a portfolio is always a tricky question. So you need to think about it slightly differently. So if somebody is positive about India as a story, right? If you're saying that India is a growth story, I'm going to be invested in it for a long period of time. Factor investing gives a very different and alternative way of looking at that growth story and participating in it at a much more lower cost compared to a typical active fund. And at the same time, it gives you the benefit of a systematic rule-based approach, which will kind of reduce your risk at the same time. So on a risk-adjusted basis over a long period of time, if someone is looking at a decent return, then factor investing definitely comes into play. And there, again, the question of how much is a very tricky question. So one way of looking at it is, if you're looking at a multi-factor model, for example, it can be a very good substitute for a pure breed index fund in a large cap index or a mid cap index or a small cap index, because what it does is it has a similar kind of rigor when it comes to looking at the key ingredients that go into successful investing, but at the same time it tries to create a bit of an alpha over and above the index.
Yeah, so I think this is taking our investing journey and experience to the next level, right? 2.0 or 3.0, that instead of just a plain vanilla Nifty 50 fund, you might want to select something where you have the Nifty 50 stocks, but there's an additional filter of, say, quality or maybe alpha, higher growth, so on and so forth. On the point of cost, Pradeep, that was a really important point for all our viewers as well. Sure. Typically, many of these multi-factor funds, if they are just based on the indices, they would be low in cost. But you mentioned that there are some blended strategies where there could be some element of active fund management as well. Yes. Are there a lot of such examples? And, is the cost substantially higher, lower, comparable to diversified funds?
Not too many examples at this stage, but we would expect more such funds to come in the times to come. But then in terms of cost, that should still be lower than an actively managed fund. Most of the smart beta strategies should be somewhere in between passive and active when it comes to cost as well.
Okay, there you go. So, an edge to your portfolio with the perhaps lower costs as well. So that sounds really good. Now we come to the tough part, Harshvardhan. Now you tell us which are the strategies that make sense to you right now, why, what are you convinced about, and what would you recommend?
So, Surabhi, let's understand in layman terms, what am I trying to do? And what am I getting in return of that? How much additional risk am I taking? That's the equation that you're trying to balance. Okay, so say, for example, I am saying that I have an option to invest into Nifty 50, which is an index fund, which cost me, say, 0.3% as a fee. My returns are going to be in line with market. If the markets go up, that's the maximum I'm going to make, whatever the market has given. And if it falls, I'm going to lose as much as the market has lost. Now, what I'm trying to do is I'm saying that, look, I'm not happy with this, or rather I want something more. So I say that, look, let me put some filter into this to say that Nifty 50, value 20. Okay, so I say I want to invest in only 20 companies. In terms of valuations, etc., they're more favorable, so that in case there is any kind of a downturn, I will fall lesser than the Nifty 50 now. And in case the markets go up, the value unlocking happens, I will make more money than the Nifty makes. That's my intent. Okay, so first I'm going to calculate is what is the additional cost am I paying for this? So obviously it's going to be a little more expensive in terms of fund management cost over and above the Nifty 50. Sure. The next element I'm going to see is that how much additional risk am I taking? Because there is going to be more risk. If Nifty 50 has, say, X risk, and I'm boiling it down to 20 companies out of that, I'm going to have more risk. So if I'm taking additional risk, what is the additional gains am I making? Sure. All you know, you may take more risk, but the returns are the same.
So risk-adjusted returns.
So risk-adjusted returns. So you have to evaluate that. Then you come to the segmentation, like the size of the company. So suppose now we looked at Nifty 50, then you have Nifty 100, then you have Nifty 200, then you have Nifty 500. So what is the universe of selection that you want to pick? So it has to be 100 companies, top 100, 200, 300. So that again will be your parameter, individual parameter. You sit down with your financial advisor and you say that, this is what we are going to be looking at, the universe of investments. Then you pick the strategy. Now, which could be alpha, could be low volatility, could be momentum, could be quality, value. It could be
whatever suits your own personal objective and style.
Correct. So, in my personal opinion, now I like 4 factors. Okay, very clearly. So, one, I like the equal weight. I like equal weight. Why? Because as I mentioned, that I have equal exposure to all the companies of the Nifty 50, etc. The other I like is alpha combined with low volatility.
Okay, so alpha will capture stocks that are likely to do better than the index.
And they're less volatile.
So that's fantastic.
That's an ideal situation, right? And the universe of stocks to pick is top 300 companies. So I have large cap, mid cap, small cap. The entire universe has been picked up. So Nifty Alpha would have a, the universe of companies would be, say, large, mid, and small. It goes across all. So if I have a strategy where I have alpha with low volatility, and if my risk-adjusted return is obviously much better, I mean, why not? And I'm paying a cost which is lesser than an active fund, but little higher than a passive fund. So I think that works very well. Value, of course, over a long term, you need to buy something at a right valuation. You may find a very good company, but if you're paying a high price for it, your profit, you coming into profitability will take longer. Okay,
so name, finally, as we're wrapping up, name some funds, some strategies, and not specific recommendations, but where you like the product and which are offering these combinations that you just
So one is, of course, Nifty equal weight. I just mentioned, I gave you the example of how the allocations are different. I like the Nifty Alpha Low Volatility 30. I believe that's the strategy that you have. You have value, of course. I mean, as simple as that. A Nifty 50 value 20 could be. You have momentum. We spoke about momentum.
Yeah.
Momentum, specifically if you have a structurally positive outlook on the market.
Sure.
So only if you are very clear that, okay, there could be volatility in the short term, but I'm positive on the structural growth of the economy and the market. So India is in that phase right now. So you would want to play the momentum strategy.
Strategies.
So, so we spoke about it the last time on the small cap side, right? So in the small cap, my personal belief is that it's a 250 universe, the small cap index.
Yeah.
I don't think it's, it would be wise for a aggressive investor or a well-heeled investor to invest in the entire basket of 250 because the small cap space, it's about stock selection.
Yeah.
So you could use a filter which is momentum and quality.
Okay.
Okay, in the small cap side.
Okay.
So it'll be Nifty, small cap 250, momentum quality 100 fund kind of a thing.
I remember this. Yes, I remember this, which is why it came to my mind that we should do a complete breakup, a full classroom on multi-factor funds. Before we sign out, Pradeep, final word, things to avoid, mistakes to avoid, and things to keep in mind while you're going about, trying your hand with these smart beta strategies.
Sure. Any smart beta strategy should be assessed on who is offering you that, how well is their model, how long has it been back tested, how robust is it, and how has it performed across market cycle. With that, then you will have a good enough information to kind of tip your toes.
Okay. All right, gentlemen, thank you very much. Very, very interesting subject at hand, and something I think going sort of forward, we will hear more product innovation and perhaps more interest from investors as well. Thank you for taking us through this one. But with that, we are completely out of time. It's a wrap on this edition of Let's Talk Money. Thank you for watching. Keep sending us your feedback, comments, and queries. See you again next week.
Let's talk money.